Greetings, everybody. Welcome to Liberty Call and Monday's weekly economic update. It is December 12th, 2022. Hope everybody's having a good day out there and had a good weekend. Markets were up quite a bit today. I think a lot of people are in hopes that the Federal Reserve is going to slow down the Fed rate increases. And I know there's some folks out there who hope they start lowering rates. I know a lot of folks in the stock market would like that because it would help their portfolios. But again, you don't stop putting out the fire until it's extinguished. And, we still have a long way to go because inflation is still a bit hot at this moment. So anyways, if it's your first time watching, please give me some big old thumbs up, like, share, subscribes. I would greatly appreciate the subscribe button's probably somewhere along the bottom here. I'd greatly appreciate if you'd subscribe, and let's go ahead and jump into today's numbers and see how things worked out. The Dow Jones was up 1.58%, closed at 34,005. S&P 500 was up 1.41%, closed at 3989. NASDAQ was up 1.26, closed at 11,143. Small caps are up over 1.5%. The VIX still was up today, 9.37%. It's at 2499. Canada was up 0.35. Brazil was down 1.98. Mexico down 1.2. Head a little further east over to the European markets. Germany was down 0.45. UK down 0.41. Same with France. Euro Stoxx was down 0.53. Netherlands was down 0.48. Spain down 0.37. Italy up 0.11. Switzerland down 0.31. And Portugal up 0.32. So most of the European markets were in the red. Nothing too terrible, about 0.5% or less, but still down. Both Russian exchanges were in the red today. The MOEX down 0.22, the RTSI down 0.93. And overnight in Asia, lots of red on that screen too. Japan was down 0.21, Australia down 0.45. Let's see here. The Shanghai in China was down 0.87. The SE component down 0.89. China A50 down 1.46. DJ Shanghai down 0.9. Hang Seng down 2.2. And the Taiwan weighted down 0.63. So other than here in the Americas, everything else was pretty awful. So again, not down terribly, but a sea of red across the screen. And I would say, just in my educated guess, is that everyone is hoping that the Fed will, they'd hope that the Fed doesn't do anything, and also they'd hope that they'd start lowering rates so that we have lots of cheap money and credit. But I don't foresee that happening anytime soon. All right, well, let's get into this week's weekly economic update. Let me get this up on the screen here. All right, the week on Wall Street, recession fears and concerns that the Fed may consider a longer rate hike cycle sent stocks lower for the week. The Dow Jones Industrial Average dropped 2.77%, while the S&P 500 fell 3.37%, and NASDAQ lost 3.99%, while internationals dipped 1.09%. Stocks slide. Stocks were under pressure much of the week due to resurgent recession fears and concerns that the Fed rate hikes may go higher for longer than current expectations. There was some good news last week on the economic front and out of China, which started to loosen COVID restrictions, but it was a week where good news was considered bad news, as any signs of economic resilience stoked worries of a longer rate hike cycle. Higher continuing jobless claims signaled economic softness, triggering a Thursday rally, but stock prices were under pressure on Friday, following a disappointing producer price index number. And you can go back and look at the report from last week, or the Friday numbers, and I covered all the economic data that came out if you want to see what that number looked like. The Labor Department reported that the PPI rose 0.3% in November and 7.4% from a year ago, though wholesale prices inflation rose at the slowest pace in 12 months since May of 2021. They exceeded market expectations. Price pressures were felt most in the services sector, where costs rose 0.4% after a 0.1% increase the month before. Goods inflation eased to a rise of 0.1%, a sharp drop from its October gain of 0.6%. Though PPI number dented the optimism around cooling inflation, November's PPI report represented an improvement from its 11.7% peak in March. So it's kind of a good news, kind of a glass half full, half empty situation. which is kind of the way it's been the last couple of months. Economic data coming out this week. Tuesday, we have the Consumer Price Index composite. Wednesday, we have the FOMC, the Fed meeting announcement. Thursday, we have jobless claims, retail sales, and industrial production. Friday, we have the Purchasing Managers Index composite. And just 2 companies reporting earnings this week. Thursday, we have Adobe, and Friday, we have Darden Restaurants. Olive Garden, my favorite. All right. So let's go ahead and breeze through today's market recap and see what they had to say. S&P 500 rises as energy and tech advance. Inflation is eyed. The S&P 500 climbed Monday as investors await further economic data on inflation and an interest rate decision from the Federal Reserve later this week. Energy stocks led the gainers as oil prices were buoyed by easing concerns about energy demand after China, the world's biggest oil importer, moved further away from its zero COVID policy. Beijing announced plans to stop tracking some travel activity, and a move that could cut quarantine measures for travelers to affected COVID regions. Technology stocks, which broadly fell 3% last week, shrugged off an ongoing climb in Treasury yields as investors looked ahead to further data due Tuesday, expected to show easing price pressures. Economic forecasts that the Consumer Price Index rose 0.3% in November and 7.3% in the past 12 months, compared with 0.4 and 7.7 in the prior month, respectively. Expectations for further easing inflation, however, aren't expected to alter the Fed's monetary policy plans, with many expecting the U.S. central bank to slow the pace of rate hikes, but signal a higher for longer interest rate regime. Quote, I think that the expectations are that we will see inflation come down over time, but that doesn't mean that the Fed can turn dovish all of a sudden, end quote, said Johan Gran, head of ETF strategy at Allianz. They, in quotes, the Fed, going to continue on the hawkish path, but a little more carefully, starting out with 50 basis points on Wednesday, and more likely following up with 25 basis point hikes, Gran added. Financials were boosted by rising banking stocks, though Goldman Sachs Group paired some gains after Bloomberg reported that the investment bank is initiating further job cuts as it restructures its consumer banking business. In other news, Rivian Automotive slumped 6% after pausing plans to make electric vans in Europe as the loss-making electric vehicle maker looks to conserve cash. Excuse me. All right, so that's everything there. Next up, we have a forecast coming from our friends at First Trust Financial. Brian Westbury is the chief economist who wrote this. So we're going to read through some parts of this. Predicting stock values in 2023 is tough. Unprecedented actions during COVID leaves a wide range of possible outcomes. Let us explain. As always, we start out with our capitalized profit model. That model takes a government measure of nationwide profits from the GDP report, discounted by the 10-year Treasury yield to calculate fair value for stocks. These data go back to the early 1950s, so almost 70 years. Our measure of profits, which excludes the profits earned by the Federal Reserve System, were up 2% in the third quarter and are up 7.8% from a year ago and are up 23.4% versus the pre-COVID peak. One interesting thing to think about is that while profits rose 7.8% during the year ending in Q3, the GDP price index was up 7.1%. Very slow growth in inflation-adjusted profits and higher interest rates combined to push stock values down in 2022. Using a 10-year Treasury yield of 3.6 near the Friday close to discount profits suggests the S&P 500 index is fairly valued at about 3,700, and we just covered this a minute ago. The S&P was at 39. Let's flip back over. 39.89 as of today's close. So it's a little overvalued right now based upon the current Treasury yield. At a 10-year Treasury yield of 4%, fair value would be down to 33.50. Fair value for the S&P 500 index would also be about 33.50 if the 10-year yield stays at 3.6 and profits go down 10%, which is what we'd expect to happen in a recession. What happens if the 10-year yield goes up to 4% and we get into a recession? Then fair value would be about 3,000. So that'd be about 25% drop from where we're at right now. The problem with this scenario is that if we do get a recession, the 10-year yield is unlikely to stay as high as 4%. So it appears there will be no double whammy for stocks. However, if even one of these downside risks occurs, higher rates or profits recession, a fair value drops even temporarily to 33.50, then stocks will likely spend some time below 33.50 just because stocks always vary above and below the actual fair value. That suggests the low for the S&P 500 of about 3,200. One forecast is that the U.S. economy enters a recession around mid-2023 for two reasons. First, we never fully felt the impact of the lockdowns because we flooded the system with liquidity and borrowed money. Something I've been saying, over and over again for the last year plus. Second, monetary policy is now in reverse, and monetary policy tight enough to slow inflation is likely to generate a recession as well. It's hard to see the Fed going from a very rapid M2 growth, which is the money supply, in 2020 and 2021 to essentially zero M2 growth in 2022 without the economy, at least temporarily, hitting a brick wall. However, stocks are likely to bottom within the first few months of the recession as investors realize this is not another financial panic like in 2008 and 9. That would give stocks room to rally late in the year, even if a recession continues, as equities see the light at the end of the tunnel. As a result, we are comfortable with the forecasts of the S&P 500 finishing the year around 3,900 with the Dow Jones Industrial Average at about 33,000, which is fairly close to where we're at right now. We're at 34,000 on the Dow as we speak. Not much change from where we are today. Obviously, if it turns out that Chairman Powell and the Federal Reserve have engineered a soft landing, no recession in 2023, and with the markets ending 2023 confident of not having a recession in 24, then stocks should rally substantially in 23 and easily beat our S&P 500 target of 3,900. By contrast, if it turns out a recession starts later in 23, providing less time for a rally from the bottom, or if a recession turns deeper than we expect, then stocks could finish 2023 substantially below that 3,900 number. The bottom line is that while stocks suffered this year from higher interest rates, the greatest headwind in 2023 should be lower profits. We expect the next bull market will be prolonged and strong, but for the time being, the economy still needs to pay the price for the massive artificial stimulus of 2020 and 21. Part of that bill came due this year, and we think the rest comes due next year in 23. So it's good stuff there. I always really value Brian's insights. He is a very bright fellow. And he, usually fairly close on most things he talks about. All right. One last thing we have here. It's an article from Yahoo Finance. I guess this comes from the desk of Suze Orman. If you think you're ready for retirement, think again. 5 moves to keep you out of the poorhouse. And I'm not a big fan of Suze Orman, but these are definitely some good tips for you. So number 1, take a hard look at your finances. If you haven't already, Orman says it's time to buckle down and take a deep look through your budget. Compare what you're spending to what you're saving, trim the fat where you can, and cut back on unnecessary spending so you can allocate more to your retirement savings column. Do you own a home, and are you planning to stay in it through retirement? Then Orman says you need to come up with a plan to ensure you'll have enough. You'll have your mortgage fully paid off before you retire. Downsizing your home. You may have plenty of sentimental reasons to want to stay in your current home, but if it's more space than you need and you can make money off of it, you may want to consider selling now. Not waiting until you have to sell the house makes sense, Orman says, because if you invest the profits now, you'll accrue much more interest than if you'd waited another 10 or 15 years. Quote, I don't want you to wait until you're 60 or 70 to sell the home, she says. I want you to downsize right now so that you can start saving more money right now. Number 3, beef up your emergency fund. Financial experts typically recommend you have an emergency fund of at least 3 to 6 months worth of living expenses, but Orman recommends you make that 2 to 3 years, especially for retirees. You want to have 2 to 3 years in your emergency fund, cash reserve, whatever you want to call it, because if the market goes through an extended recession, you really don't want to sell off your equity assets that are variable. You'd rather just use your cash that's sitting there and not have to sell off things at a bottom, because then you're going to sell off more shares and that's not a good thing. Yes, 3 years worth of expenses in an emergency fund. Here, her reasoning is that if the market ever takes a downturn, I just said this, you're not going to want to be withdrawing from your retirement account until it bounces back. With a substantial emergency fund, you'll be able to get by until it's once again safe to take out funds from your retirement account. If you need a little help setting up an account, you can turn to a fiduciary financial advisor. I know some people. You're welcome to reach out to me. I can point someone out. Invest in a Roth IRA. To avoid paying taxes when you make a withdrawal from your retirement account, Orman recommends you go for a Roth IRA account. Quote, later on in life, you want to be able to take that money out tax-free, in quote, she explains, because your contributions to a Roth IRA are made after tax. You won't have to deal with deductions when you withdraw. Traditional IRAs, on the other hand, aren't taxed when you make contributions, so you end up paying later. However, the IRS does set limits on how much you can contribute and who can contribute. In 2023, you'll need to have an adjusted gross income of under $153,000 or $228,000 for married filing joint filers. Most banks and brokerage firms offer these accounts, and if you're not keen on making the big investment decisions yourself, you can always open an IRA through a robo-advisor that will manage your retirement account for you. And last, update your investment portfolio. Taking a set it and forget it approach to your investment portfolio rarely pays off. You have to regularly revisit your portfolio and make sure it's still in line with your financial goals and timelines and risk. If you're not comfortable with a lot of ups and downs, you may want to reduce your risk profile. Check in with your financial advisor to ensure the balance you've got in cash, stocks, and bonds is the right amount for your retirement goals. Orman recommends either stocks or exchange-traded funds, ETFs, that pay dividends. So even if the market sees a downturn, your investments will still provide you with some income. Quote, if you happen to hit a patch where the market starts to go down, you want these stocks to still provide income for you, end quote, she says. Yeah, and I'm a big fan of dividends, dividend-paying stocks during times of uncertainty, especially during downturns. That was a valuable lesson that one of my mentors provided to me back during the 2008 and 9 debacle. And the attitude was let's get paid to wait out this downturn. And there's always blue chips out there that are going to pay a nice dividend. They're going to hold their value typically much better than your growth stocks. And over time, you should be able to weather whatever comes in front of us. So now, if you want some specific recommendations, reach out to me at dsafinancialgroup.com. We can talk about your portfolio and how we can make some adjustments. But otherwise, that's all I had for today. If anyone needs anything from me, like I said, go to my website or my email address is right here on the screen. And I hope everyone has a fantastic day, and I will talk to you next time. Bye-bye.